2012 or 2013. And I abandoned it at some point and I became a shareholder in 3 years ago. Um, so I have a lot of experience when it comes to this examination. I've passed, I've failed. So I think it's good that you're all having this session because we are able to then share some of our experiences, some of the pitfalls that we fell into, and be able to guide you so that you don't fall into those pitfalls and you're able to pass your exam as early as possible and also become a charter holder. And I can guarantee you that the reward that you unlock thereafter definitely worth all the stress. I currently work with the DFI, that's the African Development Bank, and I can also tell you that some of the lessons that we learn are directly applicable to the things that we do on a daily basis. So it's nice to meet you all. I wouldn't be able to ask you to all to introduce yourself because of time. We only have like 1 hour, so we will be going through. Uh, please send message to people who join the class. Oh, okay, okay. That's not for me. Okay, yeah. So we'll just try to run through the curriculum, go through some questions, and then see what we can cover in within 1 hour. Um, my expectation is that a lot of you are familiar with the ethics material that we'll be covering today, and that what we'll just be doing here today will be to rub minds and to solve some questions together, give you some of the major pointers that you need to focus on for questions and some of the tricks that you need to be aware of, in order to unlock the right answers to the question. So I'm going to start sharing my screen now. Uh, are you guys okay with me leaving my, uh, you know, just confirm? You can leave a chat on. Okay. Yes, does yes mean take it off or leave it on? Just to confirm. Okay. Um, hold on. Okay, anyway. So I'm leaving my screen, my camera on. And so a quick one, when we're talking about ethics, right? From the general point of view, ethics just trying to say this is what we should do, this is how we should behave, right? As a professional in the investment industry, there are expectations that the CFA Institute have of us, right? There are ways that we're expected to behave. There are things that we're expected to avoid. And what the code of ethics and standard of professional conduct is trying to establish is that we need to adhere to these certain behavior traits so that we can uplift the integrity and the reputation of the institute, of our profession, and also give comfort to people bringing their money into the sector for investment purposes. And you can just put yourself in the shoe of investors generally. So just imagine you have some money to invest and you want to give it to people to manage the funds for you. You wouldn't give it to somebody that you don't trust, right? You wouldn't give it to somebody that you don't believe have a strong ethical upholding because they'll probably mismanage your funds. You won't be able to get your funds back. Or even if you get your funds back, you won't be able to get reasonable returns on it. So what the code of ethics is trying to do is to then establish guidelines that people should consider, right? Some of those guidelines are requirements, no negotiation. You have to follow them. Why some of them are recommendation. Now, why they're recommendation, they are not mandatory, but it is good to have. Now, so those are the kind of things you then need to start considering that when some things are good to have, does that mean that they are unlawful if you don't do them? So no, that's not the situation. But the point is when some things are recommended, it means that they make you look more presentable, more ethical, and then you find that people that see you with those behavior traits or that recognizes your organization with those principles will be more comfortable coming to you, coming to your organization to say, manage my funds for me. right? So those are critical things. And a typical example that I can cite was, okay, don't let me call their name, but there was this particular investment firm that, couple of us, some of our friends, we came together, we put funds together, and then, we were investing with a friend who was also a charter holder, and then at some point, we got some information about him, not to being forthcoming. And what we did at the end of the day was just to pull our funds almost immediately. Even at the end of the day, we realized that, some of those information we got were not the way it seems to be. But the point was the damage was already done the moment that those information were started spreading, even though they were not true. Right. So sometimes they may have a negative impact, even though, we also expected to, use judgment and then just don't react based on impulse. But the point I'm trying to make is that even when things are not true, when people just create false information about you and put them out there, it can have a major impact on you almost immediately before you start correcting that narrative out there in the market. Why that action itself is also a violation of the code of ethics, but the point is not everybody is a candidate in the CFA program or a CFA charter holder. And one understanding you need to have, and which is likely to be tested, will be um, who the code of standard is applicable to. So you need to have that clarity. The code of standard is applicable to CFA candidates and CFA charter holders. It does not apply to people that are not, a member of the CFA society. While it is expected that they should adopt the standard, but they don't have an obligation to uphold the standard. So it is you and I that have that obligation to uphold the standard. So I'm taking this time to quickly just highlight some of these critical points before we then start going into the curriculum and see what we can quickly highlight within this 1 hour timeline that we have. So again, you see, as a candidate in a CFA program, you are both expected and required to meet the high ethical standard. So it is an expectation of you. Now, some of the other things that I also need to highlight to you is that what you see is that some organizations, they will have their own code that may be a little bit different from the code of standard, right? Their code may be stricter than the code of standard, code of ethics rather, of the CFA Institute, and it may be less strict as well. So in that situation, what should you do? Which of the standards should you adhere to? Should you adhere to your organizational standards, or should you go with the CFA Institute standard? Right. So the code requires you to adhere to the most strict of the standard that is available to you. So if the code of ethics is stricter than your company's code of governance or code of ethics, then you need to adhere to the CFA Institute's code of standard. If it's the opposite and it's your company's code that is stronger than or that is more stricter than the CFA code of ethics, then your expectation is to adhere to the organization's code of standard. If the law of a country where your company operates, which also governs the activities, right, or maybe see the law of the capital markets where you operate, if it is stricter than the code of ethics, and then your expectation is that you will adhere to that standard. And now, do you understand? So you need to have that clarity. This is also a common area that can be tested. Now, be careful, pick my word carefully. I said can, not that it will be tested, right? So it's an area that can be tested and you need to pay attention to it. So have that clarity. When you have two conflicting codes, right, you need to stick to which one of them is more stricter. And in your exam, you will have that clarity to, to be very clear in your questions, right? That this institution has a stricter code compared to the CFA Institute, or they have a less strict code. Which one should you comply with? So when you're faced with those kind of questions, you have clarity on how to approach it, right? So let's move further. So said the word ethics, right? Ethics more or less just relates to principle. In your head, a lot of people always believe that they're ethical, right? But when they are faced with the realities of the market, you realize that some of the things that you perceive to be ethical may actually be unethical from somebody else's point of view. So effectively, if we don't have a standard, then what we will see is that we have selection when it comes to what is ethical. right? Some people will see some things as being ethical and some people will see it as being unethical, right? So that's one of the thing or one of the benefit that a code or a standard tries to establish. Now, it may not be all encompassing. It doesn't necessarily mean that everything relating to moral or ethics has been covered. But we need to have that guiding principle, and that principle will help us to then decipher what is ethical and what is not. Now, one thing I also want to highlight, I'm trying to really pick a lot of things from different point of view because of the limited timeline that we have. But one thing you also need to have at the back of your mind is that not everything that is legal is ethical, right? And not everything that is ethical is legal. So you need to have that clarity. And a typical example I can give you is this. Say, for instance, you're an investment professional, you're a safe set out or you're a candidate, and then you are protesting against maybe corruption, or maybe you are protesting against a maybe an oil company that is polluting the environment, right? And then in the course of a protection, you were arrested, right? In that case, now maybe what led to the arrest is because you stepped on private property of the oil company, for instance, or the energy company, and then that led to the arrest. Even though the arrest itself is something that, is not really of a good thing, but what led to it, even though what you were doing in terms of protesting against the environmental damage is ethical, right? The fact that you had trespassed and stepped into private property and that led to your arrest, what you've done in that regard now, you've broken the law because you've, gone beyond what is acceptable by the law. You've gone into private property, right? So in that case, you've broken the law, but what you've done by protesting is ethical. So you need to have that clear understanding that sometimes what is ethical is not legal, and sometimes what is legal is not ethical. So you need to have that clarity. And so when you're reading questions, you need to start, be able to interpret it. Okay, what this person has done, is it ethical? Is it legal? Right? You need to have that clarity. But according to the code of ethics, we need to look at those two together and make sure that there's always ethics angle into it. Okay, let me see. I think I've tried to unpack this, but now the CFA Institute, they broke standards into 7 subsects. Is it 7 or 9? Sorry, it's been a while I read ethics. So, but we're not going into that yet. What we'll do is to just touch on each one of them, right? And then do a deep dive, and if you can answer a few questions. But just about ethics generally, let's look at this question. So which of the following statements is most accurate, right? Um, Ethics can be described as a commitment to upholding the law, right? An individual's personal opinion about right and wrong, a set of moral principles that provide guidance for our behavior. So C looks more like it because when you're talking about ethics, just like I said, ethics is expected to be like a guiding principles. It's not encompassing. It does not capture everything. Whatever you've written down as ethical code or standard for the organization of the safe or the Safe Institute is not encompassing. It does not cover everything, right? But if you have that guiding principles, you then be able to apply it to situation as they apply to you, right? You then be able to decipher that this doesn't look right, right? From an ethical point of view, I should not be doing this. From my ethical point of view, I should be doing things that will benefit my clients. From my ethical point of view, I should be doing things that will benefit my employer, right? Another thing you also need to have at the back of your mind is the hierarchy of people that loyalty is held to, right? When it comes to the fund management business, at the top of that cadre is your clients because your clients will bring money for your employer to manage. And you, as an employee, you are managing the money of your clients on behalf of your employer. So effectively, if your clients stop bringing money to your employer to manage, that means your employer is out of business. And when your employer is out of business, it means you're out of job, right? So you have to always remember that the duty of loyalty is number one to your employer. I mean, sorry, number one to your client. After your client, your employer is next. And after your employer, that's where you are at the bottom of the pyramid, right? Because if anything happens to those two people above you, you're out of job. You're not making money. If anything happens to your client, your employer is not making money. Your employer is out of work, right? And then by extension, you're out of work. If your client is fine, but you broke your employer's code and standard, you're out of work as well. Okay. And by extension as well, if your employer feels like an injustice has occurred in the market, they pull their money from the capital market, what do you think happens? The whole economy suffers because when people don't trust the system and they pull their resources away from the system, then it creates a vacuum and then the system can even collapse. That's why you see the likes of central bank step in to say these are systemic bank. If you allow this bank to fail, to create a systemic shock across the banking sector, across the financial sector, and then it can lead to the doom of the economy. So these are some of the things we need to also have at the back of our mind as we are reading questions and trying to understand where does this hierarchy stand? What should we do? We need to have them at the back of our mind. Okay. So yeah, this is correct. Say the next one is which of the following statements is most accurate? Standard of conduct are a necessary component of any code. Standard of conduct serve as a general guide regarding proper conduct by a member of a group. Standard of conduct serve as a benchmark for the minimally acceptable behavior required of a member of group. This looks more like key to me. And the reason I said so is that standard of conduct is not all encompassing, or just like I mentioned, ethics, standards, they don't capture everything, right? They're just creating a benchmark or baseline for you to adhere to. And then you apply them to your situation and say, how do they apply to my situation? If I'm in this situation, how should I behave? And then you'll be able to then decipher. Though when you're reading it, you realize that some of the options, they look similar, right? But you need to then be able to speak into the nitty-gritty. So yeah, C is the correct answer. Yeah. Okay. Let me just see which other portion is reasonable for us to touch on. If you have any question, please raise just indicate. Let me try to let me bring this to the side so I can see. Aha, okay, great. Can you please zoom in on the page? Apologies. Is this better? Is this better? Can you confirm, Oluwafemi? All right, wonderful. Okay, let me see. So look at this. Successful investment professionals are disciplined and consistent, and they think a great deal about what they do and how they do it. Now, one thing you need to understand is when we're talking about profession, the fact that you're in the investment industry, uh, that's a profession in itself, right? So if we don't have whatever guides our activities, then it speaks negatively about the profession, about the industry itself, right? So it is a critical element of what we do and what inspire confidence in how we do our job. Early in my career, okay, maybe before I share that, let me just go into other element. Okay, so let's look at this. Which of the following statements is most accurate? Investment professionals have a special responsibility to act ethically because A, the industry is heavily regulated. They are entrusted to protect clients' assets. The profession requires compliance with its code of ethics. Which one will you choose here? Okay, thank you. Okay, great. I can see B, B, B. Yeah, exactly. So B is the correct answer because they are entrusted to protect client assets. Now, in your actual exam, you may see something that will also talk about employer. Just like I mentioned very early on, you need to always remember that hierarchy. Your client come first. So if you have a situation whereby they're talking about client, they're talking about employer, you have to go for your client first, right? So you need to have that at the back of your mind. So yeah, correct. B. Okay, let's look at this next one. Which of the following statement best complete the following sentence? Professionals use their specialized knowledge and skills in service to others to advance their career to the exclusive benefit of their employer. Which one will you go for? Okay, okay. Can see A, can see B, I can see C. Okay, all right. I can see a lot of C, a lot of A. All right. So for me, let's just quickly look at all the options. Let's start from C. Say for the exclusive benefit of their employer, right? Again, remember what I said earlier, client first, followed by employer, and then the employee at the base. So this B is saying to advance their own career. So when you say to advance their own career, that's the employee itself. So it can never be B because we said employer is above employee. So effectively, B is a better option compared to A. And one of the things you also have to learn when you're writing an exam is if you're faced with uncertainty, you are not sure about what's the right answer. There is this thing they always say, probability. When you have three options, your probability of guessing right is 33.3%, right? But if you're able to knock down one of the options and say, definitely this one is not the right answer, then you are left with two options to choose from. And then your chances of getting it right becomes 50-50, right? So then you can now say, okay, let me take a bet on this one, even if you're not clear. But most likely, when you knock out one option and say that I'm left with two options, there's a chance that if you read the question again and then look at those two options, you may then be able to narrow down what the right answer is. So from this now, we already said earlier that employees are the base of this hierarchy. And option B is telling you that to advance their career. So this career means employee's career. So option B is out of it. You knock it out, right? Because option C is talking about employer. So effectively, option C is above option B in the hierarchy of things because we're talking about employer, right? So we are now left with option A and option C. So when they say in service to others, what does that mean? Right? So then you need to start thinking broadly. When they say others, what does others mean? Others can mean your clients, your employer, it can mean the industry as a whole, right? So for me, when you look at it from that point of view, exactly, you're rendering services to others. It can be to your employer, it can be to your employer, to your clients, it can be to regulators, it can be to the overall industry. So effectively, that makes A your best option and not C. So that's the way you have to think about it. Number one, knock out the wrongest of all the options, knock it out. And then you're left with two options. And then you can then narrow down. Read the questions again, narrow down, right? So option A is the correct one. Okay, so let me see. Number three, which of the following statement is most accurate? A professional's code of ethics includes standard of conduct or, or specific benchmark for behavior. Uh, Code of ethics ensure that all members of the profession will act ethically at all times. Code of ethics publicly communicate the shared principles and expected behavior of professional members. Which one will you go for? Okay. Okay. Somebody wrote V. Was that a mistake? Okay. Okay. I see a lot of B. I saw a lot of C as well. So one thing okay, let's just look at it. Include A said include standard of conduct or specific benchmark for behavior. That looks like it. right? But let's look at B. It ensures that all members of a profession will act ethically at all times. So the ethics is just a standard, right? It does not have power to enforce or to force people to act. So people have to develop the willingness to behave ethically. And the way that it can also be forced, but not necessarily forced, but people have to develop that principle. And there are different ways people can develop the principle to act ethically, either through their employer or through the regulator of the industry. So the regulator will insist that all licensee, right, must have a code of ethics, which is the standard. The Nigerian SEC has a standard. You must have your code of ethics, right? So they have their own standard, then they expect you to either adopt that or to improve on it. So that way, once your employer have a code of ethics, your expectation as an employee is that you must adhere to that code of ethics. If you don't adhere to it, they sanction you, or you may even lose your job, right? So, but the point is, we've seen cases of people still not adhering to the code of ethics and still behaving unethically. So the code cannot ensure that people will adhere to it at all times. But the code is there for us to adopt, create incentives around it to make sure that people adhere to those ethical standards. So for me, B is out of it, right? So you knock it out. So you have now let's look at option C. Publicly communicate the shared principle and expected behavior of a profession's member. So we are left with option A and option C because both of them look likely, right? Option A is saying that include standards of conduct or specific benchmark for behavior. Option C is publicly communicate the shared principles and expected behavior. Both of them are very likely, but I'll go for C, right? I've not gone through this, so I will, but I think I'll opt for C. Let's see, option C. Yeah, exactly. So a professional's code of ethics publicly communicate the shared principle and expected behavior of professional members. The existence of a code and ethics does not ensure that all members will behave in a manner consistent with the code and act ethically at all times. A profession will often establish a disciplinary process to address alleged violation of the code of ethics. A profession may adopt standard of conduct and enhance and clarify the code of ethics. So while option A also look like it, right, includes standard of code or specific benchmark, but this looks more like it. So these are the dilemma that you will face. You may have two options that will closely like correct answer. But again, like I said, when you knock out the most obvious wrong answers, then you can now take your time to go back to the question, read it again, and then pick the right answers, right? Great. So, there are challenges to ethical behavior, right? They call some of them situational influences that you may find yourself in a situation whereby you're being influenced by an external factors, right? Coming from maybe somebody trying to manipulate you or somebody creating an incentive for you to behave in an unethical manner, maybe monetarily or in any other form, right? So to manage situational influences, now this to manage this situational influence, there are some of the things that you need to have, right? You need to have a process, right? We call it ethical framework. So ethical framework more or less is saying that we need to have a specific framework or standard within which when we are faced with the situation, right, we can then assess that situation within that framework. So that way it can help us to then determine the action we want to take is ethical or not, right? So if we just like we have the code or the standard that say when you're faced with this, do like this and all that. So when you have a framework, the ethical framework, what the ethical framework will do is to help you to frame your thinking. And I say, okay, who are my stakeholders in this case? I have my employer or my supervisors or my clients. Do I have conflict of interest in this situation? Maybe there's a monetary incentive that is being dangled in front of you like a carrot. Then you feel like, okay, if I, how to what extent is this thing influencing my behavior, right? So the framework will more or less help you to guide your thinking to then make decisions that is ethical, right? I don't want to go deeper into ethical framework, but I just want to quickly highlight it. Okay, sorry. All right. Which of the following will most likely determine whether an individual will behave unethically? Right. Now, look, read the question very well. Which of the following will most likely determine whether an individual will behave unethically? The first one is saying that the person's character, the person's internal traits and intrinsic motivation, external factors such as environmental or cultural elements. Which one do you think is the right answer? Okay. Yeah, I like the answer, the perspective of Arafat. Right. Okay. A, B. So let's say which one will most likely determine whether an individual will behave unethically, right? Somebody's character can definitely influence how they will behave, right? That's, I agree, it can be, right? But let me just leave that. We'll come back to it, right? Let's say the person's internal trait and intrinsic motivation, right? So what is the difference between A and B? They look the same because internal traits informs character, right? Intrinsic motivation also informs character. If you are primarily an unethical person, it's coming from the inside, right? And then it's also what drives your motivation because if you're an unethical person, that maybe you prioritize money or you just prioritize seeing people suffer, that becomes your motivation. You just want to see people suffer. You just want to see people lose money, right? So, again, like I said, don't rush into picking your answers. When we were writing level one, I think we had 3 minutes per question, right? I don't know if that is still the case, but I think you have enough time, right? Was it 3 minutes? Sorry, I've forgotten. Um, so yeah, so you need to read it carefully because if you rush, you may rush to make the wrong decision. So don't rush. Read the question, understand the question, read the options, understand the options, and then eliminate the one that is clearest to you as the wrong option, right? So external factors such as environmental or cultural elements will most likely than whether an individual will behave unethically. Okay. So for me, it looks more like an external factor, right? The environment, the culture you live in, because as an individual, as you're growing up, one of the things that will shape you, right? Even if you're an ethical person, you came from a good environment, you came from a good family, a good home, well brought up. If you find yourself in an environment that is filled with charlatans, at the end of the day, you are likely to find yourself to behave like one. Now, look at the word. They said most likely, right? So your personal character may be there. You may have that character and you are from an upright family. Personally, you will not compromise, right? It's because you are in an environment that does not tempt you to compromise, right? The same thing with internal traits and all of that. If you have a good trait, good personal behavior, exactly, thank you. Show me your friend and I'll tell you who you are, right? So that is it. So if you find yourself in a bad environment, there's a high chance that you will behave in an unethical way, right? So option C. Okay. Let's quickly look at this before we move on to the others. Which of the following statement is most accurate? Large financial rewards, such as bonuses, are the most powerful situational influences. When decision making focuses on short term factors, the likelihood of ethical conduct increases. Situational influences can motivate individuals to act in the short-term self-interest without recognizing the long-term risk or consequence for themselves and others. Which one will you choose? Okay, I see a lot of C. Okay, wonderful, wonderful. Yes, this is correct, right? Now, when you go with option B, you can easily mistake it. But if you look at the question, so when decision making focuses on short-term factors, the likelihood of ethical conduct increases. Maybe what will have made this thing correct would be ethical misconduct, not conduct. Because ethical conduct can be positive and it can be negative, right? So we don't know it is they're saying here, So, but if they included misconduct, this will have been a correct answer as well, right? So, but yeah, C is the most correct answer to me as well. C. All right, good. Okay. Just like I think I've addressed this early on, right? That ethics and legal standard. Some things may be legally right, but it doesn't mean that they're ethical. And some things may be ethical, it doesn't mean they are legal. So you need to then be able to, I mean, once you have that understanding, then you then need to be able to then say, okay, this is good, this is not good. Because of time, let's just go into questions. Which of the following statements is most accurate? All legal behavior is ethical behavior. Some ethical behavior may be illegal, right? So legal standard represent the highest standard. Okay, great. Exactly. Exactly. Yeah, that's correct. Exactly. So B, we don't need to spend more. So just have that at the back of your mind. And you can see this is civil disobedience is an example of what may be illegal. Okay, illegal behavior that some consider to be ethical. And a typical, I mean, I've shared it before. People like what's her name? The former Minister of Education. I always forget. Ezekwesili. She's been arrested several times for protesting, bring back our girls, and all of that. So many people have been arrested for civil disobedience and all of that. But even though what they've done is illegal, but it's not unethical. So you need to be able to then distinguish between what is ethical and what is illegal. So as long as what you're doing is ethical, right? We're not saying go and do what is illegal, right? But if it is ethical, there's a high chance that it may be legal. But again, not all ethical behaviors are legal. So you need to be able to distinguish between the two. Question number 2. Which of the following statement is most accurate? Increased regulations are the most useful means to reduce unethical behavior by market participants. Regulators quickly design and implement laws and regulations to address practices that adversely affect the fairness and efficiency of the market. C, new laws designed to reduce or eliminate conduct that adversely affect the market can create opportunities for different but similar problematic conduct. Which one do we think? Okay, I see an answer already. Yeah, you're right. Yeah, correct answer is C. As we are developing new policies to mitigate risk and all that, they create loopholes for other problems. So the reality is you cannot have one policy fits all. People will always find a way to circumvent, look for loopholes, look for unclear definitions, and then they will tell you some certain thing is subject to interpretation in the court of law, right? So some people, that's their job. Once a new policy comes up, their job is to for loopholes or how to circumvent that rule. That's their job, and they will figure it out. So effectively, some laws sometimes can create, they will solve that problem, but they will create another problem. So it can happen, right? So as lawmakers, some of us will grow to that point in the future where we start developing policies and all of that. We need to be mindful of that so that when we are developing policies, we try to be as all-encompassing as possible, even though that is very hard to achieve. But at the end of the day, we need to also have it at the back of our mind and also know that there's a possibility that there will be loopholes, right? Yeah, absolutely. Okay, so I want to read good. Let's just quickly go into the code of ethics, or is it the standards now? I talked about ethical framework early on, right? Ethical decision making framework. So just like I said, the framework is supposed to help us guide how we think, so that when we are faced with situation, before we make a final decision, we try to think about it and say, if I make this decision and apply, if I use this framework to synthesize the decision I want to make, will I be making the right decision? Am I making the right decision? And this guides you. And then you're able to then say, okay, I don't need to go ahead with this decision. I think there was a particular example they cited there. If you, I'll advise you that you take your time to just read all of these things, just to make a sense of it. Okay, let me just go to the standard quickly. So I'll just quickly touch on the standard. I think, when is my time up? 1:30. So I think let me just check to be sure that we still have sufficient time. So apologies. Mm, okay, I think we still have some time. Okay, we're up to 4:15. We have just around 17 minutes more, exactly. So let's go into the standards and just quickly touch on them. Okay, apologies. Why is it not listing them here? Okay, there's nowhere where I want. Okay, okay, preambles. Aha. So we have the standards of professional conduct. Now, you don't need to know all these things in this format, like say standard one, professionalism, standard 1A, knowledge of the law, 1B, independence and objectivity, misrepresentation. You don't need to know it in this order. Well, the way I learned it, right, is to understand what each of these elements is saying. So I don't need to know professionalism, knowledge of the law. All I just need to focus on it. What is knowledge of the law, right? What is independence and objectivity? That was the way I went about it. So the moment I understand what this is, because the actual exam, when they bring questions around, say for instance, knowledge of the law, they will refer to standard 1A, right? Or standard 1B. They will refer to it and then they will not put it there, standard 1A, knowledge of the law. Do you get? So maybe under professionalism dash knowledge of the law. They will write it that way. So effectively what you need to understand is independence and objectivity. What does it mean? What's it trying to say? That's what you need to understand. So if you start from standard 1A, which talks about knowledge of the law, you as a professional that you're operating in the market, right? Either you're a research analyst or you're a portfolio manager, you're a corporate finance person, you are expected to understand the law that guides what you do, right? Even though you don't have the total knowledge of the law, but you need to have a reasonable level of understanding of what guides what you can do and what you cannot do. Do you understand? So effectively, if your firm has a code of ethics, your expectation is that you will have read it. You have an idea of what is acceptable by your organization and what is not acceptable, right? Maybe you cannot steal your client's money or you cannot steal your employer's money. You cannot talk anyhow to your client. You cannot use your client's account fund for particular purposes. You should have that understanding. You cannot use insider information to make gains for yourself or for client or for your employer. You need to have those understanding, right? So that's what knowledge of the law is just trying to say. You understand what laws applies to your activities. You understand what law applies to your industry and all of that. Because if you don't understand that law, then you are not a good professional. You are a bad professional, right? Because if you don't understand the law, there's a high chance that you will make decision that contravenes the law. So that's what knowledge of the law is trying to say. So any question they bring around knowledge of the law is to test that you understand that, okay, there is law that is existing and that we need to adhere to that law. Just like you have the code of ethics that you should adhere to the required element of the code of ethics. Do you understand? So that's what knowledge of the law is trying to treat. Independence and objectivity. Now, these mostly apply to people that make independent decisions, and some of them are um, research analysts, portfolio managers that are managing client funds, corporate finance that are doing, capital raising for clients and all of that, you know, and so many, there's so many forms as well. But I think those are the three critical elements. And also in the stockbroking business as well, you have that element as well, the brokers and all of that need to make independent decision. So what you see is that the expectation is that when you're making investment decision, you should be able to use your own understanding, to then be able to make a decision. You need to exercise independent judgment, whereby you've been well trained, you've been trusted to make decisions, and then you make a recommendation based on your understanding of the market, based on your research, which is based on facts, right? And then you say, this is my recommendation. And if anybody wants to assess your recommendation, they do the assessment and then they tell you, okay, we align with your view. And if they say they disagree with your view and then they justify it, you should only change your ground if they have a reasonable basis. Do you understand? So if their basis is not reasonable, there's no evidence to back their review, then it doesn't make sense for you to change your view. So there are ethic webinars that address this issue. This session is revision for level one. Oh, okay. Apologies. Okay. So this has been addressed. So let's just see if we can quickly address some couple of questions. Okay. So let's just attempt these first three questions. Thank you, Yemi, for highlighting this. So which of the following statement best describe an aspect of professional conduct program, right? So we'll just look at these first three. Which of the following statement best address an aspect of professional conduct program process? Inquiries are not initiated in response to information provided by the media. Investigation results in disciplinary review committee panel for each case. Investigation may include requesting a written explanation from the member. Have we addressed this? Can anybody address this? Which of the following statement best describe an aspect of professional conduct program? Yeah. Okay. Okay, that's correct. Yeah. Question 2. A current code of ethics principle read in full promotes the integrity, okay, and viability of the global capital market, promotes the integrity of and uphold the rule governing capital markets, promote the integrity and viability of the global capital market, and the ultimate benefit. Okay, yeah. Okay, I can see B. I can see C. Yeah, C is the right answer. And viability of the global capital market for the ultimate benefit of the society. Yeah. So question 3, which of the following is correct with regards to the standards of professional conduct? They require supervisors to focus only on detection and prevention of violation. They set ethical conduct requirements for members and candidates that have remained unchanged since the creation. They address the risk and limitations of recommendation being made to clients. Question 3, what will be our response to that? Okay. 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 So even though option A looks a bit good, there is one major flaws in question A. So they require supervisors to focus only. I think this is the problem with this option on the detection and prevention of violation. This is one of their job, not only their job, right? So this is the major problem with this one. They set ethical conduct requirements for members and candidates that have remained unchanged since their creation. This is also one of their job, not the only thing. So say they address risk and limitations of recommendation being made to clients. So yeah, this doesn't have any limitation. These two elements have limitation sets in them. Okay. Sorry, let me quickly move as well. 6. Okay, let me just go back. Apologies. So this is the best way to address it if I really want to do it the right way. Okay, so we've done all of this. Okay, so we understand independence and objectivity, misrepresentation as well. I think we have an understanding. Okay, so let me just go to this question because we don't have time. I apologize again. Okay, professionalism, we've done this. Okay, let's just go into question straight. Ah, okay, sorry. Let me just, this thing is going to take a lot of my time. Okay, okay. Let's look at these questions. Smith, a research analyst with a brokerage firm, decides to change his recommendation for the common stock of a green company incorporation from a buy to a sell. Is mail he mails this change to investment advice to all firm clients on Wednesday. The day after the mailing, a client called with a buy order for 500 shares of green company. In this circumstance, Smith should do what? Remember, he decided to change his recommendation from for the common stock from buy to sell, right? So what should be the response? Okay, can see B. Advise the client change the recommendation before accepting the order. Okay. Absolutely. Okay, I think you guys are ready for this exam. Yeah, okay. So yeah, not C, not accept the order because it is contrary to the firm's recommendation. So before clients owns their money. They can decide what they want to do. They can, if you say they should not buy and they decide that they want to buy, they can override the recommendation. So what you should do is to advise a customer of the change in recommendation. Maybe they didn't see your communication. So, but if they still insist that they want to buy, even though your recommendation is a sell. You don't have a choice. You just make sure that they communicate the order to you officially via your firm approved communication channel, maybe via emails and all of that, because you need to show evidence of that. Question two, which statement about a manager's use of client brokerage commission violated codes and standard? So a client may direct a manager to use the client's brokerage commission to purchase goods and services for that client. Client brokerage commission should be used to benefit the client and should be commensurate with the value of the brokerage and research services. The client brokerage commissions may be directed to pay for the investment manager's operating expense. So which one is the correct answer? Okay. You can see B and C. Okay. Anybody else? Okay. C is the correct answer. They say which of them violates the code and standard. These two clearly do not violate because when you're using brokerage commissions, you have to use it to the benefit of the client, right? So the client has given the person the permission in this case because the commission is being used to purchase goods and services for the client. Here, the commission, is being used to the benefit of the client, to benefit the client, and should be commensurate. So this is fine. But however, you can never use client brokerage commissions for managers' operating expenses. This is a no-no. Okay, so you can never do this. So this is the problem with this. Okay, so in your case, it's easy. You should just cancel out these two elements and just go for this one. So one more question here. Jamieson is a junior research analyst with Howard and Howard, a brokerage and investment banking firm. Howard and Howard's mergers and acquisition department has represented the Britland Company in all of its acquisition for the past 20 years. Two of Howard's and Howard's senior officers had directors in various Britland subsidiaries. Okay, Jamieson has been asked to write a research report on Britland. what is the best course of action for her to follow? One, Jamieson may write the report, but must refrain from expressing any opinion because of the special relationship between the two companies. Jamieson should not write the report because the two Howard and Howard officers serve as directors of the subsidiaries of Britland. Jamieson may write the report if she discloses the director relationship between the two companies. So which one will you go for here? C, B, okay, C, C. Okay, okay. I see a lot of C's and B's. Okay, so the way you need to look at when you are in conflicts, when you have or conflicting situation, your best bet is to always disclose. Have that at the back of your mind. When there is a conflict of interest, your solution is to make sure you disclose. Right. So in this case, write your normal recommendation, you write the research, you do your normal recommendation, but you then need to disclose so that whoever is reading your research and your recommendation will be aware of this potential conflict, and then they can use their judgment to then determine if they want to go ahead and make the investment based on your recommendation. But if you avoid to make that disclosure, that's where you violate the code of ethics. Okay. So yeah, that's that with this. Let me see if there's any other section we can move to, or maybe another set of questions actually. I think that's okay. So let's look at question 25 or 24. Which of the following statements is a stated purpose of disclosure in standard force? Is it 6C referral fee? Okay. A, disclosure will allow the client to request discounted service fee. Disclosure will help the client evaluate any possible partiality shown in the recommendation of service. Disclosure means advising a prospective client about the referral arrangement once a formal client relationship has been established. What do you think this is? Okay, okay. I'm seeing a lot of B. Okay. All right. Thank you. So why is C not correct? So I can see the disclosure will help the client evaluate any possible partiality shown in the recommendation of service. Okay. So this is good, but I'm conflicted here. Disclosure means advising a prospective client. Disclosure will help the client. Okay. Which of the following purpose of disclosure standard referrals fee? Okay, so now referrals fee is when you refer, it always relates to probably a new customer to whoever you're referring to, right? So it's a disclosure will help the client evaluate any potential partiality shown in the recommendation of service. Okay. Disclosure means advising a prospective client about the referral arrangement once a formal client relationship has been established. No, no. B is the right answer. B is the right answer. Yeah. Oh, the session ends in 1 minute. Okay. So thank you so much. Unfortunately, we won't be able to go further. Um,
Thank you so much.
Exactly. Yeah. Thank you, Rukawe, for your comment as well. I think that's the right one. So yeah, you can see some of these options are very similar. So you need to be very, very diligent in making your recommendation or choosing your answer. Okay. Thank you. Thank you, colleagues. Wishing you all the
Thank
best in your
you.
exam.
Thank you, Anoluwa Olajide CFA. Thank you so much for that insightful session and for making it as interactive as possible. Thank you so much.
Thank you.
Everyone, please stay seated. We'll be having our next session now. Bringing our speaker up on board. So please stay seated. Thank you. Um, yes. Damilare, please confirm that you can hear me or that you can speak at this point.
Hello, good afternoon. I can hear
Thank you.
you.
So lovely to have you on the call. So Damilare Ojo will be taking us through economics for the next 2 hours. Please stay seated. Write your questions down so that you can ask them after he's done. Thank you, Damilare. You have the floor.
Thank you very much, Jessica, and good afternoon, everyone. Nice to be here with you today um, to discuss economics in about 2 hours for level one. Well, I'm sure you've heard we don't have much time over and over again, but yeah, same here. I'm sharing my screen now. Hopefully, you can see. This is coming up as I'm talking. So, I believe everyone is as prepared as possible at this point in time as the exams are very near. And what we'll try to do is to discuss economics, the economics curriculum for CFA level one in about 2 hours. We'll try and cover as much as we can. Obviously, we have very limited time, and we'll just try to focus on the key concepts that I think are most relevant for us to talk about. Okay, so I think I stopped sharing my screen. Let me reshare that. Okay. Okay, I hope you can still see my screen. There are a couple of topics in the curriculum that that makes up the curriculum rather, but we won't be able to cover everything. And what we'll try to do is to touch on some of the key ones. Like the curriculum would say that every part of the curriculum is testable. However, we try to just focus on some of the ones that we think are more important. Maybe that's not the correct word, but just given the time that we have. And the first of them is the firm and market structures. As we move along as well, we'll see some of the questions. I mean, we'll try to practice some questions along the way so that we can also use those to test our level of preparedness for the exam or understanding of the content of the curriculum. Okay, so I won't dwell much on the learning outcomes. I'll just move on to talk about the key things that's most important under this particular topic. Now, the first of them is market structure, the snapshot of them. And what is important at this point is to note that as far as the curriculum is concerned, and as far as economics itself, generally speaking, is concerned, we have four broad categories of market structure, with each of them having their peculiar characteristics. However, we also have some factors that are common to all of them, which is what this slide is trying to show us. The common factors, and then we'll see the peculiar factors in the next slide. Now, on a general note, when we hear about market structure, what the CFA curriculum wants us to understand so some of the key things they want us to understand. One is, where do you say a firm is maximizing profit? And as the first bullet point here is telling us, all firms maximize profits where marginal revenue equals to marginal cost. That is a golden rule that all of us should know, or we should be very aware of, that all firms maximize profits where marginal revenue equals to marginal cost. That is a general rule. One thing that I would point out at this point is we can restate this particular rule in one of the market structures. However, I will talk about that on the next slide. But whatever market we are talking about, whether perfect competition, monopolistic competition, oligopoly, or monopoly, the profit maximization rule is that marginal revenue must equal to marginal cost. And we should know that marginal revenue is the extra revenue that the firm gets when it produces or sells one extra unit, while marginal cost is the cost of producing that one extra unit. When you produce one extra unit of your output, you spend an extra cost, that's the marginal cost, and then when you sell that extra unit, you get an extra revenue, which is what you call your marginal revenue. The point where the extra benefits equals to the extra cost is where a firm is maximizing profits. I'm emphasizing that because it's a very crucial foundation for understanding market structures as far as economics is concerned. Okay, next point is saying how do we calculate? I mean, it's trying to answer the question of how we calculate profits as far as economics is concerned. We calculate profits by by subtracting total cost from total revenue. So we say profit is total revenue minus total cost. However, we can restate that identity. We can restate it as average revenue minus average cost multiplied by quantity, where your average revenue multiplied by quantity is your total revenue, and your average cost multiplied by quantity is your total cost. Okay, I hope everyone can still hear me loud and clear and see my slide. So the same thing, your average revenue is also known as price. That is something that we also need to take note of, that when economists say average revenue, it's the same thing as price, regardless of the market where you are at, right? So average revenue is same thing as price, which means you can also restate profit calculation as price minus average costs, or everything multiplied by quantity produced. Next key point that we should note that is common to all the market structures is that a firm breaks even where total revenue is equal to total cost. I think that is pretty simple. Your revenue, what you earn, is equal to what you spend in making that output. That is where you say you have zero economic profit, which means you are not making any economic profit. Neither are you making a loss. So you are just at a break-even point. And since we said that total revenue is average revenue times quantity, and total cost is average cost times quantity, we can also restate the break-even point as the point where the output level where average revenue equals to average cost, and it's also equivalent to where price equals average cost. It is important to just note these different identities, the ones that can be restated in different ways, because that is one of the points where the questions or the options can seem tricky. So when you know that, I mean, you can just be familiar with one particular way of stating something, and then if it is restated in another way in the exam, it can get some people confused. But once you know the different ways and you see the linkages in the different ways of restating a particular identity, you would see that if questions come up in that regard, you'll be able to select the right answer. Okay, so that is why I'm just restating some of those identities in the different forms that they can take. Now, the next point talks about where a firm should continue producing. And the next two bullet points: when should a firm continue producing in the short run, and when should a firm shut down in the long run? When should a firm continue producing in the short run? Now, in economics, we have what we call sunk costs. We typically refer to fixed costs in the short run as sunk costs, which means they are costs that you can't recover. There's nothing you can do about them. So they are unavoidable. So it then means that when a firm is making a short run decision, a short run production or economic decision, it should not consider those fixed costs. You should only consider your variable costs. And what is that saying? It says a firm should continue producing in the short run if earning negative profits, but unavoidable fixed costs are covered. This is saying that as far as you cover your fixed costs, you are fine in the short run. You should not consider those fixed costs as much as your variable costs. It is when you are unable to cover your variable cost that you should shut down in the short run. So a firm should continue producing, even if profits are negative, but it is able to cover its fixed costs. That is when a firm should continue operating in the short run. However, in the long run, a firm should shut down if marginal revenue is less than marginal cost. Remember that firms maximize profits. Going back to the first bullet point, firms maximize profits where MR equals MC. At any point in time where MR is then less than MC, which means your additional benefits is less than your additional cost. You are having a higher additional cost than your additional revenue, then the firm should shut down in the long run. Okay, that is a very important concept for us to note when discussing market structures. Right. Moving on to the next point, it says firms may earn excess profit in the short run, but low barriers to entry will lead to zero economic profit in the long run. You'll see some words in bold. They are key concepts that we should take note of. Okay, so in the short run, we are saying firms can make excess profits. Now, but in markets where you have low barriers to entry, firms cannot make excess profits in the long run. Okay, I'll take that again. In the short run, it is possible for firms in any given market to make excess profits, which means total revenue is greater than total costs. You are making positive or excess economic profit. However, if there are low barriers to entry, then what would happen is more firms are going to be attracted to that economic profit that existing firms are making. So you see more firms coming into that market. As more firms come into that market, because there are low barriers to entry, that's a very important condition to central to what we are discussing right now. If there are low barriers to entry, then more firms would be enticed into that market by the excess profit that the existing firms are making. And what would then happen is they are going to compete away that excess profit. And in the long run, all firms will then make zero economic profit, which means they would just operate at their break-even point. Now, the same thing, the reverse would be the case if firms are currently making negative profits. That means they are making loss in the short run. As far as there are also low barriers to exit, it's easy for firms to exit. Then you see some firms exiting that market, and as more firms exit that market, existing firms can then make zero economic profit, which we also call normal profit in the long run. Okay, so you can hear zero economic profit. You can hear it can also be called normal profit. They are the same thing in economics. So the main point is that in any market where you have low barriers to entry, firms cannot make um, positive economic profit in the long run. They can only make normal profit or zero economic profit in the long run. That is a very important point for us to note. All right, moving on, we have a downward sloping long run average cost curve. Means the firm is enjoying economies of scale. Okay, so I'm going to bring in the last three bullet points and use the long run average cost to explain them. Now, normally your average cost curve is U-shaped, or more specifically, your long run average cost curve is U-shaped. So, which means it is at some point you have the downward sloping portion, at some point you have the lowest portion, and then after the lowest portion, you have the turning point where it then has an upward sloping portion. The portion that is downward sloping is where you say the firm is enjoying economies of scale. What that means is as the firm continues to produce more and more higher quantity, the average cost is actually declining. So a question could be framed in a way such that if you have more outputs, so output is increasing while you have a declining average cost in the long run, you say the firm is enjoying economies of scale. Economies of scale. Now, we're at the point where you have your lowest long run average cost, that is the point where you call minimum efficient scale. Minimum efficient scale. So the downward sloping portion of your long run average cost curve, economies of scale, the lowest portion, minimum efficient scale, and then the upward sloping portion, you say the firm is experiencing these economies of scale. What that means is that long run average costs is increasing as output is increasing. You are spending more on each unit that you are producing on average. You are having these economies of scale in that instance. And there are certain things that can cause that to happen. A firm can be operating, some firms can grow so big such that there are overlaps in production process that then slows down the entire production timeline, or there are sort of it becomes so difficult to coordinate production when firms become so big. In that instance, you would then have costs increasing, average costs increasing as you produce more. So you say the firm is experiencing these economies of scale at that point in time. Okay, we'll also try, I don't know, as much as possible at the end, maybe the last 20 minutes or 15 minutes, as time would permit, to take questions that anyone might have. So if you have questions, please, you can just be noting them as we move along. Okay, moving on to the next slide now, where we then talk about the factors that are peculiar to each of these market categories. What we did in the last slide is to look at the general factors, the common factors for all the market structures. Here we are looking at the factors that are peculiar to each of the market categories. Now, perfect competition. You have many buyers and many sellers. This is one of the key features that define a perfectly competitive market. You have many buyers and many sellers, and the products that are sold in that market are identical, at least in the minds of the consumers. The products are not different, right? So in that instance, you say that the firms are, perfectly competitive. If you have everybody is selling the same tomatoes, everybody is selling the same kind of, salt, for instance. Whether you buy, salt from producer A or producer B, the function of salt is the same. If in your mind it is the same product, then the products are identical, you have many buyers and many sellers, then you have a perfectly competitive market. Now, the implication of having many sellers is that firms have no control over price. And in that instance, we say the firms in this market are price takers. They take the price as determined or detected by the forces of demand and supply. So no singular firm has control over market price. That then means that in this market, and it is only in this market, that price equals marginal revenue. Okay, you can do a simple calculation to just test this out. Say the firm sells sells the products at a price of 10 naira for 1 unit. And then if you increase quantity to 2, you will be saying 10 multiplied by 2. Each quantity is sold at a price of 10 naira. So when you sell 1 unit, you get 10 naira as your revenue. When you sell 2 units, you get 20 naira as your revenue. When you sell 3 units, you get 30 naira, 10 times 3 as your revenue. You can continue on and on like that. And then you can calculate the extra revenue that you make from selling each extra unit. You will see that it is the same 10. It is only in this market that price equals marginal revenue. And the reason is that firms have no control over price. They are price takers. They take the price as dictated by the forces of demand and supply. So they all sell at the same price, and that's then implies that price would equal to marginal revenue only in these markets. Now, then remember on the previous slide, we said that the profit maximizing rule for all firms, is the point where MR equals MC. Now, in this market, perfect competition, because price equals MR, we can restate the profit maximizing rule as price equals MC. I'll take that again. In all markets, marginal revenue equals marginal cost is the condition for profit maximization, right? Now, in this market, perfect competition now, we've said that price equals to marginal revenue only in this market because the demand curve is flat. The demand curve is flat, which means the firms take prices as determined by the force of demand and supply. So prices does not change. It doesn't change with outputs. You have the same price regardless of the outputs that you produce. So the price curve or the demand curve is flat. Now, because the demand curve is flat in this market, we can restate the profit maximizing rule, which is MR equals MC. We can then restate it as price. We are just replacing MR with price because we said both of them are equal only in this market. So you can have a question that asks you for the profit maximizing quantity for a perfectly competitive market, and you are looking for marginal revenue equals marginal cost. Remember, you might not see marginal revenue equals marginal cost in that option because in this market, price equals marginal revenue, and so we can restate that profit maximizing rule as P equals MC. P equals MC. Okay, please take note of that. It's a very important thing for us to note. And the last point here says that firms earn zero economic profit since there is free entry and exit. I've explained the reason why you would have zero economic profit before. When you have very low barriers to entry and exit, firms earn only zero economic profit. So there are two things for us to note in this bullet point. The first one is that in a perfectly competitive market, there is free entry, there is free exit. And because of that, firms earn zero economic profit, only normal profit. That's what they earn. Those are the key peculiar factors that we should note for a perfectly competitive market. Okay. Now, moving on to the second one, monopolistic competition. Similar to perfect competition, you have many buyers and many sellers in a monopolistic competitive market. However, products are not identical as you have it in a perfectly competitive market. In a monopolistic competition, products are differentiated. Firms try to paint their own products as being different from that of their competitors. For instance, if we look at toothpaste, we have many producers of toothpaste. In Nigeria, for instance, at least we are familiar with a couple of them. You have Oral-B, you have Sensodyne, you have which one again? You have Close-Up, you have Dabur, you have different products as far as toothpaste is concerned. But each of them will try to paint their own products as being different from that of the other. So Dabur will tell you that their product is different from Oral-B, or they try to make it look different in the way they package it. So packaging is very important when you are talking about monopolistic competition. Firms try to make their products look different. Although, as far as, for economists, toothpaste is toothpaste, as far as an economist is concerned. But you see that for firms in this market, even within the same producer, so for instance, within the same, say, Oral-B, you can have maybe the one they call cavity, the one they call maximum cavity, the one they call fresh breath or whatever, the one they call Abba, Oral-B Abba or Dabur Abba. They try to paint different products as their product has been different in one way or the other. in the minds of consumers. So that is where you talk about differentiated products, and in that realm, you are in the realm of monopolistic competition. Now, because in this market products are differentiated, and firms can then sell more by reducing their prices. So Oral-B can tell you that there's a particular feature in their own toothpaste that makes them unique or different from that of Dabur. If they want to sell more, what they need to do is to reduce price, right? So firms can sell more in this market by reducing price. So which means that in this market, you have a downward sloping demand curve. Remember when we talked about perfect competition, we said you have a flat, a linear demand curve because firms cannot control price. There's nothing they can do. If they want to sell more, they sell at the dictated price, at the given price, price determined by force of demand and supply. But in a monopolistic competition, a firm can actually sell more by reducing price. Then what that implies is that you have a downward sloping demand curve, and your price is going to be higher than your marginal revenue in this market. Price is higher than marginal revenue in this market. As a matter of fact, in all the three market structures to the right, so monopolistic competition, oligopoly, and monopoly, one thing that is common to them is that firms can typically sell more by reducing price. Then you, in all those three markets, you have a downward sloping demand curve, and price is usually higher, than marginal revenue in all these three markets. It's only in perfect competition that price is equal to marginal revenue. Okay, so that is important for us to take note of as one. So you have some points that are common to perfect competition and monopolistic competition, which is mainly that there is free. I mean, there are many buyers and sellers. However, you have points where they then diverge. One is in the kind of products, right? Products are identical in a perfect competitive market, while products are differentiated through packaging, through advertisements, those kind of things. That is what you have in a monopolistic competition. All right. So moving on to the third category, oligopoly. Here you have few sellers, unlike the previous two markets structures where you have many sellers. In an oligopoly market, you have few sellers, only few sellers. And then you have what you call price war in this market, which means that some firms can be dominant in the market. You can have the leading firms in that market while you have weaker ones in that market. So the top firms, the dominant firms in an oligopoly market can engage in price war. What this means is they can afford to reduce their price just to make the less strong firms, that's the weaker firms, to be less competitive, and they can use that to chase them out of the market. We've had cases like this before as well in Nigeria. I don't know if the question is okay. No. So we've had cases like this in Nigeria in the past in some industries where you have the dominant players trying to engage in price war just to make the weaker firms to be less competitive and to chase them out of the market. That happens in an oligopoly market, and we call that price war. Now, because of this price war, what typically happens is the relationship between price and quantity is not always direct. It's not always it is not always direct as you have it in other markets. So when firms reduce their price in an oligopoly market, some other firms would try to match that price reduction, right? Just to stay competitive, because you know that for a consumer, typically you are looking for the lowest possible price if the all things being equal, as we would say in economics. Okay, so when a firm reduces price, you see other firms trying to match that price reduction. However, if a competitor, if another firm increases price, other firms would not match that price increase. They typically would ignore a price increase. So you don't have a sort of linear relationship between price and quantity in an oligopoly market. For that reason, demand curve in this market is kinged. Is kinged. I want to believe that if you've gone through the curriculum, you would have seen what a kinged demand curve looks like. So you have a kinged demand curve because firms match price reduction while they ignore price increase. So you have a kinged demand curve for that reason. And that happens in an oligopoly market. Okay, I've said before that P is also greater than MR in this market because firms can sell more by reducing price. That is a factor that is common to monopolistic competition, oligopoly, and monopoly. So price is greater than marginal revenue because the firms can increase their outputs sold by reducing the price at which they sell their products. Okay, and the last one that's major, the last major category of market structure is monopoly, where you have only one seller, only one producer of that product. And the producer, because it's only one person, it can it can control both price and quantity. However, we should note that you cannot control both at the same time. So a monopolist can control both price and quantity, but the monopolist can only control one at a time. What this means is if the monopolist wants to sell more, if he wants to increase quantity, what it needs to do is to reduce price. If you want to sell more, you reduce price. If you want price to increase, what you need to do is to reduce quantity. You can influence one by changing the other, but you cannot influence both. The monopolist cannot influence both price and quantity at the same time. You can only influence one at a time. However, it's important to still note that you can control both of them. It's just that you cannot control both of them at the same time. Okay. And the third bullet point says a monopolist has significant influence over price. Significant influence over price. Unlike a perfect competitor who has no control. You see, the third bullet point under perfect competition is that firms have zero control, no control over price. But when you come to monopoly now, the firms have significant influence over price. Okay. And again, the point we've made before that price is greater than marginal revenue because the firm can sell more by reducing price. And in a monopoly market, we should also note that there is high barrier to entry. There is high barrier to entry, which then gives the monopolists ample time to be able to influence price or quantity, depending on its objective at any point in time. All right, so let us just check our understanding of some of these concepts by looking at some questions that we have here. We have 5 questions under this one. I'll just be switching between the charts and the slides now so that we can try to answer the questions together. Yes, Oluwafemi gave us this example of the cement industry where Dangote uses price to push Lafarge and Bois here and there. Yes, that is what you have under oligopoly, right? So you have few firms and then they engage in price war. Right, question 1. The marginal revenue per unit sold for a firm doing business under conditions of perfect competition will most likely be the MR per unit sold for a firm doing business under conditions of perfect competition will most likely be. I'm sure for many of us that might have solved some questions, some practice questions, you must have seen this, the way CFA tests, the CFA Institute test our knowledge. They use most likely, least likely a lot, right? So we should be very careful when answering questions, when they say most likely, when they say least likely. And just to also point out, I encourage everyone to please solve as many questions as possible before the exam. It is in solving questions that you can actually test your understanding of the content of the curriculum. Okay, so please solve as many questions as possible, and that is what we're trying to do here as well. So the marginal revenue per unit sold under perfect competition will most likely be what? A, equal to average revenue, B, less than average revenue, and C, greater than average revenue. What is our answer to question 1? Okay, I see 1A. Somebody said oral salad. Is that a brand of, is that a toothpaste again? I've never seen that one, but we get the point. Okay, so 1A. Since we have, I mean, since everybody agree with 1A, so it says marginal revenue per unit sold for a firm doing business under conditions of perfect competition will most likely be equal to average revenue. That is correct, because we said it's only in this market, a perfectly competitive market, that the price is constant. And in any market anyway, price is average revenue in general, balance. Price is average revenue. So marginal revenue is the same thing as price in a perfectly competitive market, but we don't have price here, but we know that price is the same thing as average revenue. So MR equals AR only in a perfectly competitive market. That is correct. Thank you. Question 2. A profit maximum is least likely to occur when a profit maximum is least likely to occur when A, average total cost is minimized, B, marginal revenue is equal to marginal cost, C, the difference between total revenue and total cost is maximized. The question is, a profit maximum is least likely to occur when what? What do we have? I see 2C, 2A, 2B. Okay, we have the 3 options selected already. So we need to analyze this then. The question again is least likely. Don't forget, least likely. Least likely. Okay. Now let's analyze the options one after the other. Now, A says average total cost is minimized. A profit maximum is least likely to occur when average total cost is minimized. Okay. The question is, do we have maximum profit where average total cost is minimized? Is that the condition for having maximum profit? I'll put a question mark on that. We can look at the other options and come back to that. B, marginal revenue equals to marginal cost. We stated over and over again that the condition for profit maximization is that marginal revenue should be equal to marginal cost. So that cannot be our answer because the question is least likely. MR equals MC, that is B. That is the profit maximum condition. So, but the question is asking for the least likely. So B cannot be our answer. C says the difference between total revenue and total cost is maximized. What is profit? Profit is total revenue minus total cost. And then when you say you have a profit maximum, the question says a profit maximum. And option C says the difference between TR and TC is maximized. It's just saying itself in different ways, right? TR minus TC is profit. So when the difference between TR and TC is maximized, it then means that your profit is maximized. So C also cannot be our answer. C cannot be our answer. So we are left with option A. We'll go back to A. A says average total cost is minimized. That is not necessarily true. What we need for maximum profit is that MR equals to MC, or the difference between TR and TC is maximum. is maximized. So our answer is A because the question says least likely. Our answer is A. I hope that is clear to everyone that chose B and C earlier. Okay. Oluwafemi says the trap is the qualifier least likely. Exactly. So please let us be mindful of that trap as Oluwafemi has described it. So when you see most likely, be careful with most likely, least likely. Be very careful with them. Okay. Question 3. The short-term break-even point of production for a firm operating under perfect competition is most likely, again, most likely occur when one of the things I would also encourage us to do when we see questions that are long like this is to try and do away with the noise. I see long statements as containing a lot of noise. Just underline or highlight the important points in that question. So for me, for question 3 now, it's talking about short-term break-even points, perfect competition. What kind of market? Perfect competition. And then it says most likely. I need to be careful as well with whether we have most likely or least likely. So here we have most likely. So we can look at the question again. So the short-term break-even point of production for a firm operating under perfect competition will most likely occur at what point? Okay. So is it when price is equal to average total cost, where marginal revenue equals to marginal cost, or where marginal revenue equals to average variable cost? So at what point will you most likely have a short-term break even for perfect competitors? Okay, what are our options? I see 3B. Okay, I see 3B. Someone, Ayobami typed C. I believe that's for question. Okay, I can see A, B, C there. So we have all the options selected again. So we need to go over those points. Okay. Short-term break-even, perfect competition. Remember, short-term break-even, perfect competition. We said that in a perfectly competitive market, firms break even, or on a general note, break even is at a point where total revenue is equal to total costs, where total revenue is equal to total cost. Now, if you divide total revenue and total cost by quantity, you can restate it as where average revenue equals average cost. Remember, total revenue is average revenue times quantity, and total cost is average cost times quantity. So saying TR equals TC is the same thing as saying AR equals AC. But also remember that AR is the same thing as price. Average revenue is the same thing as price. So it then means you can also restate it. Excuse me. You can also restate that rule as P equals AC or ATC, which directly gives us option A as our answer. But we'll see why B and C are not correct. Okay. B says MR equals MC. What we need for MR equals MC is profit maximization. What this question is asking us for is break-even point. Break-even as a concept is different from profit maximization. When you say profit maximization, that is where you would require marginal revenue to be equal to marginal cost. But when you say break-even in the short run, you would require total revenue to be equal to total cost. But in these options, we don't have total revenue equals total cost. But we know that we can restate TR equals TC as AR equals AC. We also don't have AR equals AC here. However, we know that AR is the same thing as price. So our answer is that price equals AC, ATC or AC, right? So that is why A is the answer. Why is option C wrong? C says marginal revenue is equal to average variable cost. No. When you talk about break even, you don't only look at your variable cost, you look at your total cost, not just variable cost. So for that reason, we don't even consider option C. So our answer is A. I hope that is clearer. Michael is asking, is A the same for break even in the long run? Very great question. In the long run, with all costs, that question is a bit tricky, and this is the reason. In the long run, all costs become variable. In economics, we say that all costs become variable in the long run. So you can say that in the long run, break even require price to be equal to average total cost. But because all your costs are variable anyway, it could also mean that price is equal to average variable cost, or total revenue equals total variable cost. Okay, so you can either add this, it could be correct in the long run as price equals average cost. But but you can also then have price equals average variable cost in the long run. If you have variable cost in the long run, then that would be a more correct answer. That's why they usually say most likely, because in the long run, you don't have fixed costs anyway. So, which is why I said that question is a bit tricky. It depends on how the question is framed and what kind of options we have. So, A could be correct in the long run as saying price equals ATC is a break-even point. However, if you have something that says price equals AVC, average variable cost, I would say you should choose that over price equals ATC, because all costs are variable in the long run. All costs are variable in the long run. Okay. I hope that's okay. Awesome. You're welcome. So question 4. A market structure characterized by many sellers with each having some pricing power and product differentiation is best described as what? A market structure characterized by many sellers with each having some pricing power and product differentiation is best described as A, oligopoly, B, perfect competition, C, monopolistic competition. 4, C, C, C. Okay? Yes, C is the correct answer to question 4. You have many sellers. That is either perfect competition or monopolistic competition, either B or C. However, the question goes on and says each having some pricing power. Then that rules out perfect competition, because in a perfect competition, you do not have, no firms have pricing power. So we also then, have product differentiation. In a perfectly competitive market, products are the same, they are identical. So perfect competition cannot be our answer. So our answer is monopolistic competition. So C is correct for question 4. And the last one here, a company doing business in a monopolistically competitive market will most likely maximize profits when its output quantity is set such that, okay, I'll take that again. A company doing business in a monopolistically competitive market, again, a lot of noise. The question is just asking us for at what output quantity will a monopolistically competitive firm maximize profits? That is a question, because it says most likely, right? So at what point will a monopolistically competitive firm maximize profit? A, average cost is minimized, the point where average cost is minimized, or B, the output where MR equals AC, or C, where MR equals MC. At what point will a monopolistic competitor most likely maximize profit? Okay, I want us to switch here. So 5C. Okay, I think everyone agrees with C. Yes, that is correct. A monopolistically competitive firm will maximize profits where MR equals MC. Okay, that brings us to the end of that particular module on market structure. And we'll move on quickly to understanding business cycles. This is also a very important topic with its own learning objectives. Now, the first thing the curriculum wants, or the CFA Institute wants us to know under business cycle is, how do you describe business, or what are business cycles? You see, no economy can grow forever. That is a fundamental principle in economics. No economy can grow forever, and no economy will typically remain in the trough forever. So you have phases where an economy is expanding, and then you have periods of slowdown, and then you have again periods of increase in activities, economic activities picking up at some point. Later on, they slow down, they begin to decline, they reach their minimum, they reach, turn again to expand. So you have recurring expansions and contractions in economic activities. That is what you call business cycle. So the recurrent expansions and contractions in economic activities, which affect broad segments of the economy. That is what we call business cycles. And then we have four main phases that the curriculum wants us to be aware of. You have the recovery phase, the expansion, the slowdown, contraction. We have the definitions of each of the phases here. But before we go to the definitions, a key concept that we should note here is what we call output gap. Output gap. Now, for any economy, you have actual output and you have potential output. When we say potential, it's just saying what can this economy do given its entire resources, whether natural resources or human capital, human resources. What can this economy do? Let's say the economy can do 100, whatever that 100 represents, maybe 100, let's say, okay, $1 trillion. That is what the economy can do. That is its potential. However, the next question is that economy operating at its potential? What is it actually doing? So if it has the potential for $1 trillion, but it's actually doing only $500 million, it has potential for 1 trillion, it is doing 500 million. That is the actual. What it is doing is the actual. What it can do, given its resources, it's the potential. So the difference between that actual and the potential is what we call output gap. So that is the concept that I want us to be, to take note of on that business cycle. When we say output gap, it is the difference between the actual output and the potential output, which means that if actual output is equal to potential output, the economy is operating at its potential, then you have zero output gap. So actual is equal to potential, then the economy has zero output gap. It's operating at its potential. If actual is below potential, so this is actual, this is potential, actual is below potential, the economy is underperforming because the actual, it is operating below its potential. The actual is below the potential. So you would have negative output gap because by the time you do actual minus potential, you would be having negative. So you have negative output gap when actual output is less than potential. But if actual is above potential, you have a positive output gap. In that case, you say the economy is overeating. It is doing more than its potential. You can think of it as an individual, someone that has the potential to work for only, the capacity to work for only 10 hours in a day, but is actually doing 12 hours or 13 hours. It's like overstretching that individual, right? The capacity of the person is for 10 hours, but you are overstretching the person to do actual at 13. So you are overstretching. So you say the economy is overeating at that point. Okay, that takes us to the phases that we have in a business cycle. The first one that we have here is recovery. Now, when an economy has slowed down and reached its minimum, which we call the trough, okay, you say after that trough, the economy is, and when you say the economy is going through the trough, such that actual output is at its lowest level relative to potential, you say the economy is getting to its recovery phase. Now, in this case, the economic activity will be below potential, but it's starting to increase. The economy is operating below its potential, but that activity is starting to increase gradually. You have negative output gap, which begins to close, right? So the economy is actually producing below its potential, which means there is negative output gap. However, that negative output gap is beginning to close, is beginning to reduce. You say the economy is experiencing a recovery. And then at the point where output then increases and the growth rate is above average, you say the economy is expanding. Okay, this point reminds me of something that from I would say experience, gets a lot of people confused. When we say output is increasing and when we say growth rate is increasing, there are two different concepts, and we should note that it's one of the things that can be confusing when we are answering questions under business cycle. Now, if you have output at 50, let's say 50 trillion naira, let's just use that. If you have output at 50, and then it increases from 50 to 100, what you've done is that you've doubled output. The growth rate there is 100, right? So you've doubled output. Now, from that 100, if it increases to 150, output has still increased, but what has happened to growth rate? Growth rate has reduced from 100% to 50%. Because before you were coming from 50 to 100, growth rate there is 100 because you've doubled output. Now from 100, you then go to 150. Growth rate is no longer 100%, it is now 50%. Output has actually increased, but growth rate has reduced. Now, when we talk of expansion, we are talking of a phase where output is increasing, That is expansion. Okay. And then the next point says actual output rises above potential output. Actual output rises above potential output. What then happens? Consumers increase their spending, production activities increase, employment increases, investment increases, prices and interest rates may start increasing because it's more like you are having an overeating. Remember, second bullet point says actual output is then above potential output. The economy will be overeating, then prices will may start to increase, interest rates may start to increase as well. In that phase, you say you have an expansion. Now, after that expansion, you reach a peak, after which you then see a slowdown in growth rates, which is why I made a distinction between increase in output and increase in growth rates earlier. In an expansion, you have increase in output. In a slowdown, output is still increasing, but your growth rate is reducing. So, like the example I gave, your growth rate can reduce from 100% to 50%. From 50%, it reduces to 20%. From there, it reduces to 5%. The economy is still expanding. Economic outputs are still increasing, but your growth rate is actually reducing. Please take notes of that concept. It can get confusing, but if once you understand the difference between saying that output increases versus saying growth rate of output increases, you would be able to distinguish between when you have an expansion phase and when you have a slowdown phase. In a slowdown phase, there is still increase in output. However, the rate at which output is increasing would start to reduce, right? So it says economic output reaches maximum relative to potential, and then growth rate starts to reduce. Consumers remain optimistic about the economy. Inflation slows at some point and price levels may decrease. Prices may start to decrease in a slowdown. You have a slowdown phase when growth rate is reducing, inflation and prices start to reduce as well. Then after that slowdown, you then have what you call a contraction where the economy has already reached its peak and then it is beginning to decline. It is the actual output is declining, rather than saying growth rate is declining. When you say growth rate is declining, you have a slowdown. If output is increasing but growth rate is declining, you have a slowdown. But if output is declining, output itself is declining, you have a contraction. You have a contraction, which you call a recession. And if that recession is prolonged, it stays for a very long period of time, you call that a depression. And then we have outputs. Actual output will then be below the potential, and confidence in the economy both from consumers and business owners, will begin to decline in a contraction. So these are the 4 phases that the curriculum wants us to be aware of um, um, as far as business cycles are concerned. Okay, that takes us to the next key concept, which is economic indicators. And here we have 3 of them. We have leading indicators, we have coincidence indicators, and we have lagging indicators. When we say leading indicators are those indicators whose turning points usually come before those of the overall economy. What is it saying is, if you have an indicator that tells you ahead of time where the economy is headed, you call that a leading indicator. Say, for instance, the stock market. Before you actually have before you have GDP results released, for instance, the stock market would have started telling you some things about where the economy is headed. If the stock market is booming, you know that most likely GDP is going to increase. Most likely economic activities are increasing. Okay. So, but the stock market will start operating, would start showing you those signals before you actually see the outputs in the economy. So that is what you call a leading indicator. It tells you ahead of time, or it signals to you ahead of time where the overall economy is headed. It says they have value for predicting the economy's near-term future states, which is what I just explained ahead of time, right? So they predict where the economy is headed ahead of time. And then you have examples of them. Stock markets, house prices, retail sales, interest spread, consumer expectation. So there are different what you call there are different surveys and indices that are typically published by different statistical agencies or different organizations. One of them is the producers manufacturing index, the PMI, right? So the PMI can tell you ahead of time where the economy is headed. I think that just this last week, the latest PMI that was released by the CN shows a contraction for the first time in at least 2 years or thereabout, where you have the PMI being less than 50. 50 is the benchmark for the PMI. If it's above 50, if the index is above 50, it shows you expansion. If it is below 50, it shows you a contraction. Now, PMI is 50, is now 49 point something, if I recall well. It then means that you can expect that the growth rate of Nigeria's GDP in the next quarter is not, by the time they release the GDP, the NBS, Nigerian Bureau of Statistics, releases the next GDP report, you can expect that it is likely that the growth rate of the economy is likely to reduce because if we are using PMI only anyway, you have different indicators. But if we are basing our expectation only on PMI, you can expect that GDP is likely to reduce. So these are indicators that tell us where the overall economy is headed ahead of time. Now, coincidence indicators, they are those indicators whose turning points coincide with that of the overall economy, which means that their turning points are usually close to those of the overall economy. They change as the economy is also changing, almost at the same time. Unlike leading indicators that tell us ahead of time, coincidence indicators tell us their turning points are usually close to that of the economy, overall economy. They have value for identifying the economy's present state. Remember, leading indicators have value in predicting the future state, near-term future state of the economy, while coincidence indicators have value in identifying the present state of the economy. And they also have examples of them, which include industrial production index, real personal income, manufacturing, and trade sales. And then thirdly, you have the lagging indicators. These ones have turning points that take place later than those of the overall economy. They are believed to have value in identifying the economy's past condition and only change after a trend has been established. So what this is just saying is these ones have value only in identifying the past. I don't know I mean, if they are of much value like that, but yes, there are indicators like that that tells us what the economy did in the past. So you have those that tell us the future states, that is leading, the current states, which is coincident, and then the past state of the economy, which is lagging indicators. Lagging indicators. Sorry. All right. So that is much of what we'll just discuss on that business cycles, given the time that we have. We'll spend some time on fiscal and monetary policies. Let me just check the chart again. Okay. So Kenny says it might be worth noting recession happens when there's two consecutive contractions in an economy. Thank you for bringing that up. That is very correct. So we say there's a recession when you have two consecutive quarters of decline in economic activities, which means if you have a negative growth in Q1, let's say Q1, and then you also have a negative growth in Q2, that is when you can officially say that the economy is in a recession. In Q1, if that is the only period where you have a decline in economic outputs, which means negative growth, you don't call that a recession, right? It is when you have two consecutive quarters of decline in economic activities, that's when you say there is a recession. Thank you for bringing that point up. That is a very important point to also note. All right. So fiscal and monetary policies. Fiscal and monetary policies. These are two different readings in the curriculum, but we just try to bring them together just so we can manage our time and look at them side by side. Okay. Even in the curriculum, we still have that a segment where you begin to discuss the interaction between these two policies, which you're also going to look at. So we'll just look at them side by side here. The first point here is just trying to say who uses fiscal policy, who uses monetary policy. Now, fiscal policy is used by government or its agencies to, okay, the objectives are there, we'll get there. But who uses this? Fiscal policy is used by governments or its agencies. Who uses monetary policy? It is the central bank or the apex bank or the monetary authority. It can have different names in different countries. In Nigeria, it is called the Central Bank of Nigeria. In Kenya, it's also called Central Bank of Kenya. In the US, it is called the Federal Reserve Bank. In the United Kingdom, it is called the Bank of England. In different countries, you can have the apex bank or the monetary authority having different nomenclature. But the underlying point is that monetary policy is used by a central bank or an apex bank or a monetary authority, whatever name it is called, while fiscal policy is used by the government or its agencies. What are the main tools of each of these policies? For fiscal policy, the main tools are government taxes or revenue. Taxes are the major source of revenue for any government, okay? So that's why we can say taxes, or broadly speaking, it's revenue. Government spending is also a tool of fiscal policy, and transfer payments are also tools for the conduct of fiscal policy. While when you go to monetary policy, the main tools are money supply or monetary aggregates. You have credit, you have interest rates. Those are the tools of monetary policy. And what are the main objectives? On a general note, both policies are used to stabilize the economy. However, they can come in different fronts, right? So for fiscal policy, they are used to influence economic activities or to promote growth. Some fiscal policy tools are also used for wealth and income redistribution. So the government might say that some people you have different classes, economic or social classes in an economy. You have the high income earners, you have the mid income earners, you can even have the high mid, or how do they say that now? High middle income lower middle income, you can have the low income earners, and so on and so forth. Governments might have the objective of redistributing wealth and income amongst these different groups of of social class and an economy. So you can use fiscal policy to achieve that. For instance, you can manipulate your tax rates to be in a way maybe progressive so that those who are earning more would pay more tax, while those who are earning less would pay less tax. Or you can use transfer payments to take more from the rich and to support the poor. So that's what we mean by wealth and income redistribution. And it's also similar to the third point, also says resource allocation between different economic agents. That's also an objective of fiscal policy. And when you move across to monetary policy, the main objectives there are to achieve stable price levels, which we say low and stable inflation. Please note here that zero inflation is rarely an objective. It's not an objective of monetary policy. You rarely see zero inflation as a policy for monetary policy. Rarely do you have an economy that has zero inflation. Okay, although we've had countries that have experienced negative inflation before, which you call a deflation, but even they had to fight it because when you talk of the twin economic problems, you have inflation, you have unemployment. You use one of them to stabilize the other. You can increase inflation to reduce unemployment, or you can slightly increase unemployment to reduce inflation. The point here is that zero inflation is really an objective of monetary policy. What you would have as an objective is stable price levels, which means low and stable inflation. We want inflation to be low. We want it to be stable as well, so that people can easily predict inflation rather than inflation just increasing at a very at an alarming rate. Okay, and secondly, you have stable economic growth as an objective of monetary policy. Now, the next very important concept for us is expansionary and contractionary policies. Okay, so on a general note, when you say expansionary policy, whether fiscal or monetary, any policy that is aimed at increasing the to increase economic activities from different perspectives. So any policy aimed at increasing economic activity, increasing economic output, that is what you call an expansionary policy. While any policy that is, that is meant to reduce economic policy, that is meant to stabilize the economy such that you want to, maybe the economy is currently overeating and you want to slow down the level of economic activity just to bring prices down and whatnot. So you call that a contractionary policy. Okay. So for each of the policies, fiscal and monetary, you then have tools that are used to achieve each of these sides, whether expansionary or contractionary. So when we say expansionary fiscal policy now, you have an instance where government is spending more than it is collecting in revenue. So government is spending more and it has lower taxes. In that instance, you say you have an expansionary fiscal policy. What does that mean? Just think about it as an individual as well. If you are earning, let's say what you are earning is, for simplicity, 100 naira, that is your income. But what you are spending is 120. You are spending 120 while you are earning 100. So you are spending more relative to your income. Then you say that you are in an expansionary mode, right? That extra 20 in that instance must definitely be coming from somewhere, whether someone is gifting you, a family, family member, a friend, or you are dipping into your previous savings, what you've saved before, that is where you are getting that extra 20. So in a case where the government is spending more than it is earning in revenue, you call that an expansionary policy. Now, an expansionary fiscal policy. Now, I would ask, so do you have, when you are looking at it in terms of government now, and you are looking at it in terms of government budget, so you could have a budget surplus, you could have a balanced budget, and you could have a budget deficit. When you have an expansionary fiscal policy where the government is spending more than it is receiving in tax revenues, do you call that a budget surplus, a balanced budget, or a budget deficit? What would you call that? So a way to rephrase that question is an expansionary fiscal policy is most likely or can most likely be achieved by using which kind of budget? Is it budget surplus, budget deficit, or but balanced budget? Okay, I say deficit. Yes, that is correct. That is correct. Ahmad says, what is the effect of transfer payment on expansionary or contractionary under fiscal policy? Very good question as well. So transfer payments are, if you look at them, they are used to, we say they are used to redistribute wealth, right? So an example of a transfer payment would be government giving money, unemployment benefits, giving money to those who are unemployed. Now, when you give money to those who are unemployed as part of your spending, of government spending, what happens is there's more money for everybody in the economy to use to spend, right? Which then means that you are trying to expand the level of consumption in the economy. So that would easily fall under expansionary fiscal policy. So using a transfer payments, increasing transfer payments would be an expansionary fiscal policy. Okay. And then for contractionary fiscal policy, before we move to monetary policy, the reverse is the case when you talk about contractionary fiscal policy. It means that the government is spending less than it is earning in revenue. So government is reducing its spending while it is increasing its taxes. So here you have a budget surplus. So budget surplus is a contractionary fiscal policy, while budget deficit is an expansionary fiscal policy. It is important for us to take note of that. So I'll take it again. Budget surplus is a contractionary fiscal policy, while budget deficit is an expansionary fiscal policy. We have less than 45 minutes left. So I would move quickly to expansionary monetary policy, which is where you reduce interest rates. So you can, when the central bank or the monetary authority reduces interest rates, you say you have an expansionary monetary policy. Or when you have increase in money supply, you say you have an expansionary monetary policy. Any policy taken by the monetary policy authority to increase money supply or to reduce interest rates is an expansionary monetary policy. Because when you reduce interest rates, what happens is you are trying to encourage individuals and firms to access more credit. You make credits cheaper. You make it cheaper to get loans, to get credit by reducing interest rates. And so firms are encouraged to go and borrow for expansion purposes, for business purposes. So you say that is an expansionary monetary policy. And when you do the opposite of that, you have a contractionary monetary policy, in which case you are increasing interest rates and or you are reducing money supply. Okay, that is a contractionary monetary policy. All right. Moving on quickly to fiscal policy tools. The main tools of fiscal policy, you have your recurrent expenditure, you have your capital expenditure, and you have transfer payments. Recurrent expenditure, capital expenditure, and transfer payments. When we say recurrent expenditure, these are spending on recurring services. Every year, for instance, there is budgetary allocation for payment of salaries of workers, government workers. That's a recurrent expenditure. Okay, so anything that you spend on every now and then, that is recurrent expenditure. While any spending on capital projects, excuse me, such as bridges, roads, new hospitals, um, those things that you spend on that typically take a long time to construct, that is what you call capital projects, and that falls under capital expenditure. Um, then you have transfer payments, which, as I said earlier, you have examples such as unemployment benefits, tax credits, job search allowances. There are some countries that have these kinds of transfer payments, or what you call social benefits, unemployment benefits, tax credits, job search allowances. They are called transfer payment, and they're also a tool for conducting fiscal policy. Now, under government revenue, you have direct taxes and you have indirect taxes. Direct taxes include income tax, wealth tax, corporate tax, inheritance tax. Some of the things we should note as features of direct taxes is that they are difficult to adjust and they have a longer implementation time. They are difficult to adjust and they have a longer implementation time. On the contrary, for indirect taxes such as sales tax and excise duties, they are easy to adjust and they are easily deployed to achieve social changes. Let's give an example. You have what you call value added tax, which is an indirect tax. Everybody pays VAT as far as you buy one thing or the other, okay? And government does not directly take it from you. In most cases, it is either the person that you are delivering a good to that takes that VAT from you and remits to the to the government. I mean, in the form of withholding tax anyway. So, but you have your value, or maybe I should use withholding tax. I think that would be easier to explain than using VAT because you can have multiple layers, all right? So, for a withholding tax, you have somebody that you are paying that tax to as you are delivering a good or a service. But if you look at VAT as well, whenever you go and buy something at the supermarket, they charge you VAT on some products. That's what you call an indirect tax. It is not collected directly from you. You pay it to, I mean, it is not collected directly from you by the government. You pay it to the person that is delivering goods to you, while that person then remits it to the government on your behalf. However, if you look at direct taxes, you pay it directly to the government. Your income tax, for instance, your payee, your company, your employer most likely remits it on your behalf and pays the government directly for you. In any case, you are paying it directly by yourself. Okay, so those kind of taxes, direct taxes, are not easy to adjust. And then the question is, if government wants to quickly use tax to achieve an economic objective, which one should it use, or which one will be easier to use? Is it the direct tax or indirect tax? The curriculum or CFA wants us to know that it is easier to adjust indirect tax, which then means that you can easily deploy indirect taxes to achieve a fiscal objective compared to a direct tax, right? So also they want us to note the four attributes of a good tax system. One is simplicity. Second is efficiency. You have fairness and you have revenue sufficiency. What this means is any good tax system should be easy for everybody to understand, simplicity. And we can think of this in terms of the recent tax law changes that we have in Nigeria. people were having different, different interpretations. Although the government also tried as much as possible to explain over and over again the provisions of those new tax laws, but as would have it, different people still had different. There were just a lot of confusion at some point, right? A good tax system should be simple for all and sundry to understand. It should be efficient, meaning that you shouldn't use a higher amount to get a particular tax amount. So, for instance, you have a tax expectation. What you are getting in tax as revenue is 100 naira, just for simplicity again. But to get that 100 naira, you've already spent 120 naira. You've spent more to get less. That is not efficient. So if you spend maybe 30 to get 100, you are spending less to get more. That is efficiency. Fairness. A good tax system should be fair to everyone. Fairness does not necessarily mean equality, but it should mean that as much as possible, you are not overcharging some people while undercharging some people in taxes. In when you are, given the tax administration law, so it should be fair to everyone, regardless of their social class or economic group. And a good tax system should have revenue sufficiency, which means you should be able to get enough for the government to achieve its fiscal objectives or spending objectives. Okay, moving on to the roles of central bank and monetary policy tools. What are the roles of central bank? On the left-hand side of the screen, you have a monopoly supplier of the currency. In any given economy, the central bank is typically the only supplier of the currency, the monopoly supplier of the currency, so that you don't have different forms of currencies. You don't have any form of, you just have a central place where you can supply that currency. You have uniformity in terms of the currency, how it looks, what kind of design it has, and all of that. So central banks are typically the monopoly supplier of the currency. Secondly, they are the banker to the government and the banker's bank. Central banks are typically the bankers of the government, and they are also this bankers' bank. What that means is the same way you and I, we have accounts with deposit money banks. Every deposit money bank and merchant banks and whatever banks, financial institutions have accounts with the central bank as well. Okay, so central banks are the bankers' bank, and they are also the banker to the government. They are the regulator and supervisor of the payment system. Typically, the central bank or the apex bank is the regulator and supervisor of the payment system. It supervises the banking system, it conducts monetary policy, and it is the lender of last resort. Lender of last resort. What lender of last resort means is if any deposit money bank is trying to borrow money and it cannot borrow money, or maybe even the government is trying to borrow money, the last place it will go to is the central bank. It is the lender of last resort. After the bank or it's a government has tried several means, cannot get money, it can then go to the central bank to get to borrow some money. In Nigeria, we have what we call the ways and means, right? That is an example of what you call lender of last resort. It's a financing window for the government, although there are regulations around it. But just to explain the points, when we say the central bank is the lender of last resort. Okay. And then the monetary policy tools, you have three major ones that we've highlighted here. You have open market operations, you have official policy rates, and you have reserve requirements. When we say open market operations, it is increase. It's a way through which the central bank tries to influence the amount of money supply in the economy, either by selling or by purchasing. So you can have open market purchases, you can have open market sales, each of them being the opposite of the other. So open market purchases means that the central bank is buying securities from the commercial banks, or let's say deposit money banks. So when it buys, it credits their accounts, which means it is increasing the amount of money in circulation. You can see what the point says. It says open market purchases can increase broad money growth through money multiplier. When the central bank conducts an open market purchases, it buys securities from the banks, and then it credits their account. Then when it credits their account, those commercial or deposit money banks then have more money with them to to lend in credit to firms and individuals, which means you can achieve increase in broad money growth or money supply by using open market purchases. And the opposite is the case when you talk of open market sales. If the economy is at a point where the central bank wants to tame the growth of money supply, then it will engage in open market sales where it sells securities to banks, and then it gets money from them, which it then just takes money away from them to reduce the amount of money they have with them, to use or to give out in credit. And that brings us to a question I would like to ask at this point. Open market purchases, is it an expansionary monetary policy tool or a contractionary monetary policy tool? Open market purchases. Open market purchases, is that expansionary tool or a contractionary tool? Open market purchases. Okay. Okay. Expansionary. Yes. Thank you very much. Expansionary. So open market purchases is an expansionary monetary policy tool, and then open market sales is a contractionary monetary policy tool. Okay, the second monetary policy tool we have here is official policy rates, which could have different names in different countries. In Nigeria, we call it the monetary policy rate, MPR. In the US, it is called the Fed fund rate. Just has different rates in different countries. What this official policy rate does is that it influences the repo rates, which is the rate at which banks lend amongst each other. We call that the interbank lending rate. If the official policy rate is increased, you would expect that repo rates would also increase. And going to the second point as well, the official policy rate also influences the rate at which commercial banks are going to lend to firms and individuals who have approached them for credit. Okay, so in the same vein, if official policy rate is increased, you would expect that the lending rates is going to increase as well. So if a central bank wants to achieve a contractionary monetary policy using official policy rates, a contractionary policy using official policy rates, would you expect it to increase the official rate or to reduce it? If you want to achieve a contractionary monetary policy using official policy rates, what would you expect it to do? To increase the rate or to reduce it? Yes, to increase the rate. To increase the rate. Thank you very much. And the last point here says reserve requirements. Okay. Money creation process is more powerful the lower the percentage reserve requirements of banks. That's a quote from curriculum, I believe. So what this is saying is that the portion of the deposits with banks that they are required to keep with the central bank. So this is for every 100 naira that you keep with your bank. If the reserve requirements or cash reserve rates, as we call it in Nigeria, cash reserve ratio rather, CRR, if it is 30%, for every 100 naira that you keep with your commercial bank, they are required to keep a minimum of 30 naira with the central bank that they cannot use for credit, right? So which means they only have 70 with them to use for credits for every 100 naira that you keep with them. And the implication of that is that, there's something we call the money creation process. Money creation process. The higher the amount of money that banks have with them to create credit, the more they can create money in the economy, because you have what you call the money multiplier, which is one divided by the reserve the required reserve ratio. One divided by the required reserve ratio is your money multiplier. If your required reserve is the higher it is, the lower the money that can be created, the lower the money multiplier. And the lower your required reserve, the higher your money multiplier. So it means there's an inverse relationship between the reserve requirement and the money multiplier. We should note that relationship, that it is inverse, it is indirect between the money multiplier and the reserve requirements or required reserve ratio. Okay, so the higher one is, the lower the other is going to be. So it says money creation process is more powerful the lower the percentage reserve requirements of banks. So just saying that the lower your required reserve ratio, the higher the money creation process, which is also saying the higher the money multiplier. Okay. That is an important concept for us to note. Moving on to what we call inflation targeting framework. I don't think I will spend as much time here because of the time. Something. Okay, I think I will skip this slide and move on. I think this slide is more important. This material will be shared anyway, so we can look at the other ones. But given our time, I'll just move here to the interaction between fiscal policy and monetary policy. Anyway, I remember something here that I would like to just mention, that for any monetary policy authority, the expected inflation rate is more important to them than the current level of inflation. I think that is a very testable point, right? So you can have a question that says anything like, which of the following would a monetary policy authority is most likely to consider in making its monetary policy decision? Okay, you can have the current level of inflation, you can have the past level of inflation, you can have the expected inflation rate. Inflation expectation is more important to any monetary policy authority than the current level of inflation. Please just note that point. Okay. Expected inflation is more important in making monetary policy decision than the current level of inflation. All right. The curriculum also wants us to know the interaction between fiscal and monetary policies, which is when you have easy just means expansionary. So when you say an easy fiscal policy, you are saying expansionary. And when you say a tight fiscal policy, you are saying contractionary. Okay, so easy means expansionary, tight means contractionary. So when you have an easy fiscal policy and a tight monetary policy, what is the effect of that? You have higher government spending, you have a rise in interest rates and lower private sector demand. What does that mean? Sorry. So having an easy fiscal policy means the government is spending more. The government is spending more. So that's why you have an higher government spending. However, you also have a tight monetary policy, which means interest rates has been increased. For instance, the central bank is trying to reduce the amount of money in circulation or trying to reduce the inflation rate. So it increases its monetary policy rate, which then means that the the interest rates in the economy is going to increase. And if interest rates increases, you would have lower private sector demand, or what we also call something like crowding out, right? Because you have easy fiscal policies, government is spending more. it is when it wants to spend more, it has to borrow as well, most likely. It borrows more, and coupled with the fact that the monetary policy regime is tight, you have high interest rates. So the markets will not be favorable to private sector operators, which then means that you have a lower private sector demand, you have a rise in interest rates, and then the government spending as a proportion of aggregate income is going to increase. So a combination of easy fiscal policy and tight monetary policy would give us government spending being a larger proportion of aggregate demand or aggregate income. Now, when you flip those things around and then you have tight fiscal policy and an easy monetary policy, you would see that the reverse will be the case. Lower your government spending will be lower. You have low interest rates and higher private sector demand. And in this instance, private sector share of GDP would increase. The most important thing for us to note is when you have government sector, you have private sector. In what situation will government sector be higher as a proportion of aggregate income? And in what situation or circumstance would private sector share of GDP be higher? So a combination of easy fiscal policy and tight monetary policy would give us government spending being, or the government sector being a higher proportion of aggregate demand, while a combination of tight fiscal policy and easy monetary policy would give us private sector demand being a larger proportion of aggregate demand or GDP. When both fiscal and monetary policies are is easy, which means government is spending more. Monetary policy also reduces interest rates. Every people are also spending more. Individuals, private sector participants are also spending more. You generally would have higher aggregate demand because both G and I are increasing. Even C might be increasing. So because from your identity, your aggregate demand identity, Y equals C plus I plus G. When you have easy fiscal policy, easy monetary policy, your C would increase, that's the consumption expenditure. Your I, investment expenditure, would increase because you have lower interest rates. Firms can afford to get more credit and expand production. So investments would increase. You'd also have government spending more because you have easy fiscal policy. It then means there will be inflationary pressure in the economy. You have inflationary pressure in the economy. And then on the flip side, when you have both policies being tight, it then means that you have lower aggregate demand. Okay, lower aggregate demand. We have this other topic as well. Let me see. Capital flows and FX markets, and then we have exchange rate calculations. I think I will move on because we have 15 minutes more. I will quickly move on to exchange rate concept and just use the remaining time. Yes, 20 minutes, 15 minutes more, I suppose. Okay. So here, I will quickly highlight the key concepts that we have and would look at a few questions and would end on that today. For the spot rates, when you say spot rate, that is the current rate of converting one currency to another. That's just saying what is the rate as of now or as of today. We want to exchange naira to dollar. What is the exchange rate now? If you make that exchange now, the rate at which you've made it based on the prevailing exchange rate is what you call your spot rate. When you say forward rate, it is the exchange rate that is agreed upon for a future transaction date. So you can say, okay, I'm expecting dollars in 3 weeks' time. So let us agree on an exchange rate today at which we are going to exchange that dollar in the next 3 weeks or 3 months, whatever the case is. So that is a forward rate. When we say interest rate differentials, it's simply the differences in two interest rates. Excuse me, please. Okay. So interest rate differential is simply the differentials in two different interests. So you can look at the interest rate in Nigeria and the interest rate in the US, for instance. When you look at the difference between them, that's what you call interest rate differentials. It's a very key concept under exchange rate calculations, right? You have maturity of the forward contract. That is the dates of the forward contract that has been agreed on. So if we say we are making an exchange of dollar to naira in 3 months' time, that 3 months' time is our maturity, is the maturity of the forward contract. Excuse me. Cross rates, that is the exchange rate between two currencies that are not expressly quoted on the market. Okay, so you have currencies that are mostly traded in the market, and you have those that are less traded in the market. When you have the exchange rates for currencies that are less traded, that are not expressly quoted on the market, that is what you call your cross rate. We'll see an example of that, but just an example, if you are looking for the exchange rate between euro and GBP, for instance, of course, these are currencies that are quoted. But let's say that what you have at the moment is you have NGN GBP, you have NGN EUR, but you don't have EUR GBP. You can use NGN GBP, NGN EUR get to get an implied cross rate for EUR GBP. So if you have two currencies that are not expressly quoted, the exchange rates for them are not expressly quoted, but you have other currency pairs that you can use to achieve that pair that you're looking for. You call that the cross rate. Okay. And lastly, on this slide, you have what you call the triangular arbitrage. Arbitrage occurs when you have three different currencies and there is an opportunity to benefit from differences in their cross rates. Okay, so for instance, if it is cheaper for you to first buy naira, to when you have naira, let's say you have naira, you want to buy euro. Okay, you have naira, you want to buy euro. But if it is cheaper for you to first convert your naira to USD and convert USD then to euro, rather than directly converting NGN, your naira to euro, you say there is a triangular arbitrage. In cases where there are opportunities to benefit from differentials and cross rates between three different currencies, we call that a triangular arbitrage. All right, we would just look at some um, calculations now, and I have a pro tip for anyone that is trying to, that sometimes if you get confused sometimes when doing this kind of calculations, just think of any currency pair that you have as NGN USD. If you're a Nigerian, if you're a Ghanaian, you can think of it as Ghanaian cedi to USD, or just find two currency pairs that you are most familiar with and then use that to just think about what the question is saying. An example of where this can become useful is when they are asking you for an exchange rates movement and saying which currency has appreciated or which one has depreciated, or things like that. It might just be easy for you to think about such questions in terms of currency pairs that you are already familiar with. Okay, the first question here is asking us, okay, we have different questions. Why do you have one? It should be one, two, three. Apologies. Okay, so you have a spot rate 1.18 EUR to USD to EUR. Now, in exchange rates, you have what you call the price currency and the base currency. In this instance, your numerator is typically your price currency and your denominator is your base currency. So what this means is having a spot rate of 1.18 means for you have 1.18 USD to 1 euro to 1 EUR. So 1.18 USD to 1 EUR. So your price currency is your USD and your base currency is your EUR. Now they said the spot rate is 1.18 and the expected spot rate in 1 year is 1.16. Based on the above, is the EUR expected to appreciate or depreciate against the USD in 1 year? So based on this, the spot rate now is 1.18, but somebody is saying that the expected spot rate in 1 year is 1.16 USD to EUR. Are you then expecting the EUR to appreciate or depreciate against the USD? What is our answer? Okay. I see depreciate, depreciate, depreciate. Okay, that is correct. That is correct. If there's anyone that this is not clear to, or for the benefit of anyone that might not be so sure of this, I'm going to try and explain. Now, this is why I said you should also think of it in terms of your most familiar um, currency pair. Okay, so you have NG, you have USD to EUR. If I think about it as NGN to USD, my price currency is NGN and my base currency is USD. Although for this question, our price currency is USD, our base currency is EUR, but because I want to think about it as NGN USD. And then I can also do without the decimal points just to make things easy for myself. So today, you can think about it as having 118 naira to 1 USD. And then in the future, just to make the point also clearer, we can widen the gap. Instead of using 116, we can say, oh, the exchange rate is now going to decline to just 100 naira to 1 USD. Or if you are more realistic about where NGN USD is today. So today, NGN USD is around 1,380, or let's say it's 1,4. Okay, so 1,4. But you are expecting it to decline in the future to from 1,4 to say 1,000. What has happened to USD in that instance? So Naira is gaining or is expected to gain while the USD is expected to depreciate. That is what's happening here as well. So in this instance where we have USD to EUR and we are expecting a lower expected spot rate, the USD, the price currency, is expected to gain, to appreciate, which then means that the reverse will be the case for the base currency. The EUR is expected to depreciate. Okay, so thank you for that. The next question is asking by what percentage is the EUR expected to, it says appreciate or depreciate. We already know that it's depreciating, so we can just say to depreciate. By what percentage is the EUR expected to depreciate? Okay, I see 1.69, 1.69, 1.69. Okay, so yes, you calculate that. Excuse me. Okay, so you calculate that by just doing the expected rate, which is 1.16, 1.16 divided by 1.18, and then subtract 1 from that. 1.16 divided by 1.18, you subtract 1 from that. That's going to give you a negative of 1.69. Okay. Now, if the question was by what percentage is the USD expected to appreciate, how do you do that? By what percentage is the USD expected? Oh, okay, that's actually question 3. What about USD? By what percentage is it expected to appreciate against the EUR? Aha. So you see that it's not the same amount. You can't just say it is the same 1.69. No, you have to do the same thing and take the current 1.18 and divide it by 1.16 and subtract 1. That's 1.72 appreciation of the USD. Okay, thank you. Moving on to the second question here, we have currency pairs. We have USD GBP to be 1.26. We have USD EUR to be 1.1786. Based on the above, what is the EUR GBP cross rate? what is the EUR GBP cross rates? Okay, can we quickly calculate that? I would also do that from my end. So we have USD GBP and we have USD EUR. We are looking for EUR GBP. Let's do that in 1 minute or less. Okay. Are we done? Okay, we have B. Yes, 4 minutes left. We have B. Yes, B is correct. In case it's not clear to anyone, so what you need to do is you write your USD GBP. What you are trying to achieve is EUR GBP, but you have USD GBP, you have USD EUR. So the way you can achieve EUR GBP is to divide USD GBP by USD EUR. So if you write that down in a note, it will be clearer to you. So you have USD GBP, then you say divided by USD EUR. So that would then mean you have USD GBP times EUR USD. USD can cancel USD. You are left with EUR GBP. But what you are doing initially is to divide USD GBP by USD EUR. So you have 1.2604 divided by 1.786, and that will give you 1.0694, which is option B. The third question, which might be the last we'll be able to take today. A New Zealand traveler, so you have currency pairs and the spot rate. A New Zealand traveler has SGD 25,000 from his trip to Singapore and gets the above quotes from a dealer. The amount of New Zealand dollar he can expect to get is closest to what? Okay. So the guy has 25,000 SGD. He is trying to convert it to NZD. How much can he expect? Okay, let's quickly do that in 1 minute. Remember what he has is SGD and he's trying to get NZD. So you can know the currency pair you are working towards. Okay, what do we have? Someone says, I don't know what this is for. I can see B, I can see C. Okay, I believe the C is for question 3. Okay, I believe that's for question 3. So yes, I believe that is it. So that is correct. So what you need to first work towards is to get your SG, SGD in terms of your NSD, which would be that is 1 divided by 0.966 or thereabout, and then that gives you the rate that you then multiply by 25,000 and you get 24,835. Okay, that is the point at. I mean, that's how much we would be able to take today. Thank you everyone for your participation, and I wish you best of luck in the exams. Bye.
Thank you so much, Mr. Damilare Ojo. Your class was very insightful. Thank you so much for the time. Thank you so much for explaining well. Thank you so much, sir.
Thank you very much.
And please, everyone, please remember to go through the videos on YouTube. We're streaming live, so the videos are there on YouTube.